Right now, global inflation is, well, it's stubbornly high.
Yeah, it really is.
And you've got this geopolitical conflict simmering in the Middle East. So, I mean, if you look at the oldest rule book in investing, those two factors combined should mean the ultimate safe haven asset is skyrocketing.
You'd think so, yeah. Gold should be going through the roof.
But if you actually look at the financial dashboard for tonight, Monday, June 29th, 2026, the exact opposite is happening. Gold is currently staring down its most severe quarterly drop since 2013.
It's massive.
We are witnessing this historic, just absolute free fall in an asset that investors rely on for stability. It's completely breaking the traditional rules of wealth protection.
It's a phenomenal paradox, honestly. When the real-world conditions basically scream buy, but the market violently sells, you really have to look past the surface-level headlines.
Right.
You have to look at the invisible plumbing of the global financial system. Because the mechanics driving this sell-off are cold, calculated, and frankly, they're completely indifferent to what we traditionally think of as market logic.
Okay, let's unpack this. Our mission for this deep dive is to basically cut through the immediate panic. We're looking at a comprehensive evening market bulletin, and we're going to use it to decipher the exact specific mechanisms dragging down gold and silver tonight.
And there are quite a few.
Yeah, exactly. Plus, we're going to preview a massive barrage of economic data dropping later this week that will dictate the next major market swing. And finally, we'll lay out the precise short-term and long-term cash allocation strategies recommended by these sources so you know exactly how to position your portfolio in the crossfire.
Because when we actually connect the data points in this bulletin, the chaos sort of vanishes. I mean, yes, the short-term charts are flashing red, but they're following a very rigorous, logical narrative driven by macroeconomic gravity.
I sense.
Once you see the underlying forces at work, you stop reacting to the price drops and start anticipating the broader shifts in capital.
So let's start with the immediate damage, because to understand the why, we first need a microscopic look at the what. Over the weekend, gold closed comfortably around $4,088 an ounce. But as capital flowed through the Asian and European sessions today and cascaded into the afternoon, the floor just gave way.
It really did.
Gold lost anywhere from $40 to $50 an ounce, dragging it down to this dangerously low range of $4,030 to $4,050. I mean, it is perilously close to the $4,000 mark.
Yeah, and that $4,000 number, it isn't just a number on a chart. It's a critical structural tripwire in the modern algorithmic trading landscape.
A tripwire? How so?
Well, that's the unseen danger of round numbers. Institutional trading computers are programmed to recognize $4,000 as a major psychological support level.
Okay.
Because of that, thousands of traders place their automated sell orders, their stop losses, just below that line, like maybe at $3,995.
Yeah.
They do this to protect themselves if the market crashes.
But by doing that, they accidentally build a trapdoor, don't they?
Exactly.
Because if the price naturally dips below $4,000, all of those automated stop loss orders trigger at the exact same millisecond.
Yeah. They flood the market with sell requests, which drives the price down even faster. And that just triggers the next layer of stop losses further down the ladder. It creates this self-fulfilling algorithmic avalanche.
Wow. Which is why watching that $4,030 level tonight is just agonizing for traders.
Yeah.
The gravitational pull of that $4,000 trapdoor is immense.
It is. And, you know, the pressure isn't just on gold.
No. Silver is taking an even harsher beating today. It's falling 2.3% to a range of $57.50 to $58.50 per ounce.
Right.
People usually call silver the canary in the coal mine, but I prefer to think of silver as like a hybrid car engine.
Oh, I like that analogy.
Yeah, it runs on two entirely different fuel sources. On one side, it has monetary value, like gold, running on the electricity of macroeconomic policy. But on the other side, it has immense industrial value. I mean, it's used in solar panels, electronics, medical devices. So it also runs on the gasoline of global industrial demand.
That dual nature is so vital to understand. Because when silver drops sharper and faster than gold, as it's doing today, it tells you that investors aren't just souring on the idea of precious metals as a monetary safe haven.
Right.
They're simultaneously losing confidence in short-term industrial growth. So basically, both the battery and the gas tank are flashing empty.
So if both engines are stalling and all this capital is fleeing the precious metal sector in tandem, what massive underlying current is pulling them down? Where is all that money going?
Well, it's migrating to the two dominant apex predators in the financial ecosystem right now.
Which are?
The U.S. dollar and U.S. Treasury yields. You really cannot evaluate gold and silver in a vacuum. They are priced in dollars, and they compete directly for investor capital against government debt.
Got it. Let's break down the dollar's grip first. The U.S. dollar index, the DXY, is holding incredibly strong tonight, above 101 points. It's sitting right around 101.26.
Yeah, it's a powerhouse right now.
For those tracking the broader currency wars, the DXY measures the dollar's strength against a weighted basket of major foreign currencies, primarily the euro and the Japanese yen.
Exactly.
And the sources highlight that the dollar is currently on track for its biggest monthly gain in almost a year. Large speculators and hedge funds are holding the highest net long positions since 2019, meaning they are placing massive, leveraged bets that the dollar will continue to dominate.
And a muscular dollar acts as a mechanical vice grip on gold prices. Because gold is priced in U.S. dollars globally, a rising dollar means an investor in Europe using euros, or an investor in Japan using yen, has to spend more of their local currency just to buy a single ounce of gold.
So it artificially inflates the price for foreign buyers.
Precisely. Which immediately chokes off global demand. And less demand equals falling prices.
But the currency exchange rate is really only half the battle. The other half is the yield problem.
Yeah, this is huge.
U.S. 10-year Treasury yields are stubbornly high. They're hovering around 4.38%. And just as a refresher, a Treasury bond is essentially a loan you provide to the United States government, and in exchange, they pay you a guaranteed risk-free interest rate. That's the yield.
What's fascinating here is that this introduces the concept of opportunity cost. And that is the single heaviest anchor around gold's neck tonight.
How so?
Because gold is an inert asset. It sits securely in a vault, but it doesn't produce anything. It pays zero dividends. It yields zero interest.
So if you are an institutional portfolio manager overseeing, say, $10 billion in capital, you have a strict mandate to generate returns.
Right.
If the U.S. government is offering you a virtually risk-free return of 4.38% just for parking your cash in their bonds, holding a non-yielding lump of metal becomes incredibly hard to justify to your clients.
Exactly. That high yield acts as a giant vacuum, actively sucking capital out of the metals market and into government debt.
Okay, I follow the logic on the opportunity cost, but this brings us back to the central paradox we opened with. Wait, if the PCE inflation data is still high, and that's the Personal Consumption Expenditures Index, the specific inflation metric the Federal Reserve monitors most closely, shouldn't investors be flocking to gold as an inflation hedge? That's what we're always taught.
Yes, that is Finance 101. But it's failing right now because the market is no longer trading on the disease. It's trading entirely on the cure.
The cure being the Fed.
Exactly. You are entirely correct about gold's historical role. But in our current environment, high inflation forces a very specific, aggressive reaction from the Federal Reserve.
The Fed has to raise interest rates to cool down the economy and kill the inflation.
Spot on. And because the recent inflation data remains sticky, the Fed is under unrelenting pressure to maintain a hawkish, aggressive stance. I mean, the market is now factoring in 3 distinct rate hikes for 2026.
Wow, 3?
Yeah, with probability models currently showing a 61% chance of a rate hike in September alone.
So the fear of what the Fed is going to do to borrowing costs is completely eclipsing the fear of inflation itself.
Yes. Investors know that if the Fed hikes rates 3 times, bond yields will climb even higher, and the dollar will grow even stronger. The anticipation of that monetary tightening is just crushing the inflation hedge premium.
Makes total sense.
People aren't buying gold to protect against inflation because they believe the Fed's aggressive rate hikes will eventually destroy the inflation and gold along with it.
Right. That perfectly explains the macro headwinds. But gold isn't just an inflation hedge. It's a geopolitical panic room, you know?
Oh, absolutely.
When global stability fractures, capital usually runs to gold. And we just witnessed a weekend filled with significant military developments in the Middle East. So why didn't that trigger a massive safe haven rally?
You have to look at the diplomatic follow-through that occurred immediately after those developments. The critical headline that the market actually priced in was the subsequent agreement between the U.S. and Iran to resume technical talks.
And these aren't necessarily grand peace treaties. Technical talks usually refer to back-channel, highly specific negotiations. In this case, it often involves setting thresholds for nuclear enrichment or establishing maritime de-escalation protocols to prevent accidental military clashes.
And those maritime protocols are the key, because the primary geopolitical fear in the Middle East, from an economic standpoint, is a disruption of shipping lanes, specifically the Strait of Hormuz.
Right, because roughly 20% of the world's global oil consumption passes through that single narrow waterway.
Exactly. If military escalation threatens to shut that strait down, The price of oil skyrockets, which causes global transportation costs to explode, creating a massive wave of new inflation.
But because these technical talks were announced, the immediate threat to the Strait of Hormuz basically evaporated. You can see the relief instantly reflected in the crude oil markets.
It was immediate.
Brent crude, which is the global benchmark for seaborne oil, plummeted roughly 22% over the month of June. It settled right around $72.57 to $73.30 a barrel tonight. WTI crude, the U.S. domestic landlocked benchmark, is hovering around $70.
And a 22% drop in energy costs in a single month is just a massive deflation of the geopolitical risk premium. Traders no longer feel terrified of an imminent global energy shock, so they don't feel the compulsion to hide their capital in the gold market's panic room.
Which creates an interesting secondary effect. If oil prices crash by 22%, the cost to manufacture and transport goods drops. That directly eases some of the headline inflation pressures.
Right.
So does cheaper oil give the Federal Reserve an excuse to cancel those impending rate hikes?
It helps, but it is definitely not a silver bullet. The Fed focuses heavily on core inflation, which strips out volatile sectors like food and energy.
Right, the sticky stuff.
Exactly. Core inflation is currently being driven by things like housing, insurance, and the service sector. Those areas are still incredibly stubborn. So while lower oil prices are welcome news for the consumer, they simply are not enough to alter the Fed's immediate interest rate trajectory.
So the dollar still rules.
Yeah. The muscular dollar and those high treasury yields easily overpower any slight, lingering support gold might receive from background geopolitical murmurs. Right now, the Fed's monetary policy is the only gravitational force that truly matters to the market.
Here's where it gets really interesting. If macroeconomic data, specifically data that influences the Fed, is the only thing steering the ship, we are about to sail into a hurricane.
They really are.
The market is effectively holding its breath for a grueling gauntlet of U.S. employment data dropping this week. This is a high-stakes jobs week.
The labor market data is basically the final puzzle piece the Fed needs before they decide on that September rate hike.
So let's lay out the gauntlet. First, we have the JOLT-TUS report, the Job Openings and Labor Turnover Survey. This measures the demand side of the equation. It tells us how many open positions employers are actively trying to fill.
Yep.
Then we have the ADP Private Payrolls Report, which acts as sort of a preliminary appetizer for the main event. Finally, we get the overall unemployment rate alongside the single most important metric of the month, non-farm payrolls, or the NFP.
And the NFP dictates the immediate momentum for global markets. It reveals exactly how many actual jobs the U.S. economy added or lost in the previous month.
And there's a fun, vital scheduling quirk to keep in mind here. The NFP traditionally drops on the first Friday of the month, but this week it's coming out a day early on Thursday due to the U.S. Independence Day holiday on Friday.
And that scheduling shift changes the mechanics of the market entirely.
How so?
Because Friday is a holiday, many institutional traders will close their books and leave for a long weekend on Wednesday afternoon. By the time the NFP data hits on Thursday morning, market liquidity will be remarkably thin.
Ah, I see.
When you drop a massive high-volume data bomb into a thinly traded market, the price swings become violent and exaggerated.
So how do we interpret the jobs data when it hits? I think a natural assumption is that a booming economy with strong job creation is fundamentally good for all assets. But in this specific environment, we are dealing with the good news is bad news paradox.
We are indeed.
Walk us through how excellent news for the American worker translates into terrible news for the gold market.
It goes back to the Federal Reserve's dual mandate. Congress requires the Fed to balance two goals: keep inflation low and maximize employment. Right now, they are fighting a war against inflation.
Right.
If the Thursday NFP report shows that the U.S. added hundreds of thousands of new jobs, and the JOLTS report shows employers are desperately raising wages to attract talent, the Fed views that as a dangerously overheated engine.
Because wage inflation is incredibly sticky. If people are making more money, they spend more money, which allows corporations to keep raising prices.
Precisely. So if the labor market is roaring, the Fed looks at that data and concludes the economy is robust enough to swallow more medicine. It gives them the green light to maintain high interest rates or execute those 3 additional hikes.
Ouch.
And as we've detailed, higher rates supercharge the dollar, inflate bond yields, and crush gold. Therefore, a good jobs report is devastating bad news for the precious metals market in the short term.
And on the flip side, if the jobs data comes in weak.
If unemployment spikes and job creation stalls, the Fed becomes terrified of pushing the economy into a deep, destructive recession. They might abandon their hawkish posture and signal that rate cuts are coming to stimulate growth.
Okay.
The mere suggestion of rate cuts would immediately lower bond yields, weaken the dollar, and throw gold a massive lifeline. But until those exact numbers are released on Thursday, capital is trapped in a highly cautious, downward-sloping holding pattern. No institution wants to place a billion-dollar bet on gold until they know the Fed's next move.
Okay, so we've mapped out the macro headwinds, the geopolitical deflation, and the looming data gauntlet. Now let's translate all of this intelligence into actionable strategy. So what does this all mean for the listener's wallet today? Let's look at the specific playbook recommended by tonight's market bulletins, starting with a very stark warning for the short-term trader.
Right, the immediate technical trend for gold is pointing downward, or best grinding sideways. As we discussed earlier, there is a severe risk of the price crashing through that $4,000 structural floor.
The guidance here is explicit. Do not attempt to buy the dip right now. The bulletin actively discourages traders from trying to anticipate the bottom or chasing technical rebounds. You wait to see if the $4,000 floor breaks before you even consider surfing the market for short-term gains. And crucially, the sources emphasize that leverage should be strictly avoided.
Absolutely. Using borrowed money to amplify your trades is always risky, but in a week where we have thin holiday liquidity colliding with volatile NFP jobs data, utilizing leverage is practically financial suicide.
That bad.
Yeah. A sudden algorithmic price swing could trigger a margin call and liquidate your entire account in seconds.
Yikes. So for the day trader, the strategy is aggressive patience. But what about the long-term holder? If you purchased physical gold or silver near the top of the market a few weeks ago, watching this decline is likely inducing some severe anxiety.
It is, but the narrative for long-term holders operates on a completely different frequency. The overarching multi-year bull cycle for gold is absolutely not over. The structural foundations supporting the market remain entirely intact.
So the short-term turbulence of a Thursday jobs report does not erase the long-term macroeconomic reality.
Exactly. Long-term support is buoyed by two massive forces. First, you have the ongoing, record-setting accumulation of physical gold by global central banks. Sovereign nations are not day trading the NFP report.
No, they're not.
They are purchasing physical bullion to permanently diversify their national reserves away from the U.S. dollar.
Ah, the de-dollarization trend. After witnessing Western nations freeze foreign dollar reserves during recent geopolitical conflicts, central banks in emerging markets realized that physical gold stored in their own vaults is the only bearer asset that cannot be sanctioned or erased with a keystroke.
They're buying for generational wealth preservation and geopolitical immunity. That creates a massive, permanent floor of demand under the market. And second, you have the mathematical endgame of the Federal Reserve.
The inevitable pivot.
Yes. The Fed cannot sustain these punishingly high interest rates indefinitely without eventually fracturing something foundational in the U.S. economy, whether that is the commercial real estate sector or the regional banking system.
Right, something has to give.
At some point, perhaps in late 2026 or early 2027, they will be forced to pivot to an easing cycle. They will have to cut rates. And when that inevitable shift occurs, the crushing headwinds of high yields and a strong dollar will instantly transform into massive tailwinds for gold.
So the directive for the long-term investor is resolute. Do not panic sell. If your timeline is measured in years, you maintain your position. But this leads to a fascinating tactical question. What if you are currently sitting on a large pile of cash, deliberately waiting for the absolute bottom of this dip to deploy your capital? The sources outline a very specific allocation strategy for that sidelined money.
They do. They recommend placing your unallocated capital into 3 to 6 month bank savings products.
And they specifically flag a 6-month term as optimal right now. What makes a 6-month window the strategic sweet spot?
It leverages the exact macro environment that is currently hurting gold. Because the Fed has rates set so high, banks are offering incredibly lucrative, risk-free yields on short-term savings.
Okay.
Locking in a 6-month term guarantees you capture those peak interest rates while simultaneously keeping you safely insulated from the messy, volatile rate hike speculation that will dominate the market through the summer and fall.
But the strategy includes a caveat, right? You shouldn't lock up every single dollar.
No, definitely not. The bulletin emphasizes the need to keep a small portion of your capital highly liquid in standard checking or short-term accounts.
Why is that?
You need immediate dry powder available because if the market severely overreacts to the jobs data on Thursday, driving gold prices down to an irrational level, you want the liquidity to immediately capitalize on a generational buying opportunity.
It is the ultimate exercise in balancing guaranteed yield with tactical preparedness.
It allows you to basically get paid while you wait.
When we pull back and examine the entirety of this June 29th market bulletin, we're really looking at a masterclass in financial tension. On one side, we have acute short-term pain inflicted by a dominant U.S. dollar, lucrative treasury yields, and a hawkish Federal Reserve desperately trying to engineer a softer labor market.
Yeah.
But on the other side, we have a quiet, unbroken structural bull market, steadily supported by sovereign central banks, playing a multi-decade game of geopolitical chess.
It is the eternal battle between immediate market psychology and underlying structural reality.
Which leaves you with a final lingering thought to evaluate as you review your own portfolio tonight. If retail investors and short-term traders are fleeing the gold market in a panic over immediate Fed rate hikes, while the world's central banks continue to act as the ultimate long-term buyers, whose timeline are you aligning your own wealth with?
That is the big question.
Are you reacting to the noise of the next 3 months, or are you positioning for the reality of the next 3 years?
Understanding the difference between a delay and a reversal is really the defining trait of a successful investor in this environment.
That is the perfect place to leave it. Thank you for joining us for this deep dive into the underlying mechanics of the market. If you found this helpful, please like the video, subscribe to the channel, and comment with your own opinion on where the market is heading. Keep digging into the data, keep questioning the consensus, and above all, stay curious. We will catch you on the next one.